All right. Cool. Welcome to News of the Mighty World, everybody. And today we have, man, there's so much going on. Let's start with China. China is the big, massive panda being stimulated in the corner right now. So I think we should be talking about that. Recently, they unveiled a gigantic stimulus package after only days ago struggling because of deflation, worrying about that. Stock market over there is up around 20% within a week. Phenomenal. So they've introduced measures like lowering mortgage rates. They've reduced the initial deposits required for second homes. They've injected tons of liquidity into the stock market, and it's working. It's early days, of course, and they're trying, I guess, to get over their fear of not reaching their 5% growth target. So tell me what's going on, and I guess really importantly, will it work, and how does it affect New Zealand here?
Big set of questions there. So what's going on? You've said it all. A huge amount of stimulus is going through that economy right now. So last week, People's Bank of China came out, 3 big measures to help the property market. Number one, a 50-point reduction in the interest rate. Interestingly, emerging market, I find this interesting. Their core rate is now 3.5%, so significantly below us, the US, other core markets. Reduced the collateral requirements on second homes, which we've talked about, to make it so that more people can go and afford to buy houses. And also what they've done is they're providing funding for some of the state-owned enterprises to go in and start buying houses as well, so unvacant property. So given we kind of know that property is one of the core issues that are holding back the economy right now, because there's been a massive overbuild in the last 5 years, and this is really about how do they take control and how do they bring a whole lot back and kind of give a little bit of oomph to that property market as well. Simultaneously, which kind of shows they're pretty desperate, they're also providing $100 billion of liquidity to the stock market to kind of start to try and kind of provide some support, push prices up. And they're exploring setting up a stabilization fund. If they do this, or what this looks like, will be kind of interesting. But I think it's a recognition that the stock market is, look, for a lot of people, the stock market is a bit of a barometer of the success or otherwise of an economy. And so therefore, what they are desperately trying to do is go, cool, well, how do we actually protect our stock market, and how do we actually make this a whole lot better? And there's nothing better, as we know from the West, than government intervention. It's a great way to kind of sort everything out. They've done this because it was becoming increasingly clear that there is no way that any form of data manipulation can show that they're going to get to 5% growth this year. It's kind of one of the core tenets of the Chinese Communist Party, is they've managed, particularly over the last kind of 35 years, is they've managed to lift that country out of poverty. And it's been one of the greatest wealth creation booms of all time that's happened in China. And all of a sudden that's stopping. So as a government, if you can no longer promise to make your kind of the next generation better off, and you've kind of stopped on that wealth creation, you've got to do something. And that's what we're seeing right now on the way through. Coming back to the third of your questions, will it work? Who knows? I think that's the question. I mean, the stock markets believe that it might work. Over the last week, we've seen as Shanghai Composites up almost 20%, up 9% last night, which I suspect was due to a bit of government intervention and that $100 billion worth of liquidity hitting the market. But more importantly, what we've also seen is that the stocks of a lot of the European luxury goods companies, so the LVMHs, the Pradas, all of those kind of companies are massively up over the last week. As the kind of people around the world are going, yeah, is this kind of time, and is the economy about to bounce? We've also had a number of hedge funds who have been saying for the last couple of weeks, it's time to buy China, time to buy China. The earnings differential is so great, and we kind of are going there. I think, though, the question is, and I guess this is what we're starting to see over the last 20 years of Chinese history, whether it was 2008, where the GFC was averted by a massive infrastructure boom and construction boom that kind of started to unwind, and then we had a COVID expansion and stimulus boom. That's kind of meant that we've got way too much infrastructure in China. We've got way too much housing. Is this going to do something similar? And so I don't know whether, I guess the question is still out. And particularly when we look at what happened in Japan, is the question still is, does basically throwing money at the problem, solve it, or does it just kind of kick the can down the road a little bit further? That would be the big question in my book.
How does it affect us? Because if I just think about this because of the interconnectedness with global markets, if you're creating, if one economy is creating a lot more currency and injecting it into financial markets where people can buy and sell, it's kind of like displacement. It kind of just pushes money out the other side, and you see it through their stock market, their property market first. Maybe you see it in the price of gold, which is already at all-time highs. Maybe you start to see that being one of the big drivers in the price of Bitcoin as well, which you can tell that things are starting to change. We're recording this start of October, known as Uptober in crypto community. So we have all this kind of concentration of all these threads now into this rope, yanking on some of these assets. And this China story, I just think is going to be interesting, even in New Zealand, where there's a foreign buyer ban, but still overseas money can still find its way into our market here. I just wonder what happens from here, right?
I think for New Zealand, it's really interesting, right? There's kind of two sides to it. So New Zealand and our largest export partner now, followed actually by the US, but Australia's been bumped down to third, which I find interesting. What is kind of pretty interesting is, so on one hand, stimulus, greater economy growth, all of the wood, our meat, our milk, all of those products, this should help, right? Because a stronger Chinese economy means a stronger kind of demand profile, particularly when you look at tourism. It's one of the economies that's nowhere near where it was pre-COVID. We had built an industry around that bulk kind of Chinese tourists. They can't afford to come anymore, so they're not coming. So look, I think on one hand, a strong China is generally pretty good for New Zealand from an economic standpoint, kind of no matter what you believe from a security perspective. The flip side, though, is with what we are starting to see, we're seeing interest rates lower, flooding money into the economy. What that should do is that should also push the exchange rate down. Coming back to 3.5% in China versus 5.25 here in New Zealand, it means that a stronger New Zealand dollar versus the Chinese yuan is likely. And that won't make life easy for our exporters as well. I think, if anything, that's kind of what we're starting to see through the rest of the world, with New Zealand being a bit of an outlier as to where we're sitting. That's going to make it pretty hard for us to kind of stay in that position. And you've seen that, right, with New Zealand dollar now hitting 62 cents against the US. We've got, just a whole lot of things are making it hard for us to remain that outlier, I guess, along with Australia, with those very strong rates. So there's some upsides and some downsides for New Zealand here, but fundamentally, if we want the New Zealand economy to be strong, we need the Chinese economy strong.
Yeah, we're all connected. We're all in this together. And I think that everything is going to go through step changes where every time there is announcements coming out of central banks, there's going to be adjustments with currencies, adjustments with expectations. So I guess it's not totally accurate to say that, hey, if our dollar is worth more, exporters are going to do better or worse. It really just, because this is going to be a process that might actually end up happening over a relatively short time frame in terms of these rate reductions. That's kind of my growing suspicion, is that we're going to see rates fall a little bit further, a little bit faster. Starting to think that. And maybe it's just because I changed the type of orange juice that I'm drinking in the morning, or it could be something far bigger afoot. So let's talk about the US, shall we? We've talked about China. Big situation going on there. And I think that'll be really fun to watch that over the next couple of weeks. But over in the US, interesting murmurings, even just in the last couple of days, from Jay Powell, with the last Federal Reserve meeting that happened in September with a 50 basis point cut. That wasn't a unanimous decision, and for the first time since 2005. One of the Fed governors, Michelle Bowman, dissented from the interest rate decision. She was the Lone Ranger, and she said, no, we should be a little bit more modest here, because she was concerned, and I think rightly so, that the inflation risks associated with a 50-point cut could be a little bit too great. And this is something that I've been thinking about a lot lately here in New Zealand as well, as calls grow louder for a more significant rate reduction, regardless of whether it's right or wrong. I think we're going to see rates drop faster. However, I also agree that it could reignite inflation. But the question for you is, how would you, going back to the US, how would you interpret that dissent over there? And what do you think it means?
I think it's pretty big, right? It's very unusual. It's the first time that it's happened since 2005, so almost 20 years. And there have been a lot of big decisions and a lot of very impactful decisions in that time as well. So I think this is kind of an important sign. But I think the other part is we also, when the dot plot was released, showing kind of what's the range of potential outcomes of where neutral sits. And this is what I found really interesting, right? It was actually the widest dot plot range almost that's ever been said, right? Where they talked about kind of different people were talking about neutral being anywhere from 2.3% all the way up to 3.8%. And that's a very wide range. And to me, this indicates where we are. I've been talking about this a lot over the last 6 months, and that it could easily fall one way or the other. The kind of continual flip-flopping between hard landing, soft landing. I think it's just yet another sign that actually no one really has any idea what's going on. This recovery that we're seeing from the pandemic, the post-pandemic stimulus, the supply chain shocks, it's just a strange world that I think no one really knows. And to me, this data set really reinforces that point that we don't know. I think what it also very strongly reinforces to me is anyone banking on significantly lower interest rates for the medium term needs to be very careful, because I think supposedly the largest research-driven organisation in the world and some of the smartest people out there, and they've got no idea what's going on. So it makes it really, really hard for some of us to kind of figure this out, right? So I find it fascinating. It kind of reinforces the view that, no one knows. And don't be surprised if we get another flip-flop from reserve banks around the world, right? And actually, the other really important point to raise is when we had the what's the words I'm looking for? When the Federal Reserve did drop their rates by 50 points the other day, bond markets actually kind of fell, which means yields on the 5 and the 10 years rose. As markets went, set, we can see now that inflation is not such an important consideration for them. So even the bond market, kind of the way it reacted, did kind of take a little bit out of that as well.
Unpack that a little bit more. So what does that mean? Because to me, it kind of sounds like if yields go up, it kind of sounds like the market is expecting interest rates will have to go up in the medium to longer term.
Yields, kind of, the short term came down. So kind of as we talk about interest rates, we talk about a curve. So 1 year, 3 year, 5 year, 10 year, it's kind of the main points on the curve. There's bonds on every single one of those years in between times as well. But what's really, really critical is that what happened here is kind of, you saw the 5 years and the 10 years, the interest rates actually went up. And the reason they went up was a combination of two things. One was kind of a little bit no longer concerned so much on the hard landing. But also the second other big reason, which quite a few interest rate market commentators came out with and said, hold on a sec, you've dropped the interest rates by 50 basis points when we've got 4.5% unemployment. We've got inflation still sitting at 3.1%. We've got an economy that's likely to grow kind of on trend this year. And yet we're still dropping interest rates. To me, that means that you don't care about your interest rate mandate anymore. Or sorry, in the US, remember, they don't have a strict inflation mandate like we do here. But I think it really showed to investors and bond investors in particular that the Federal Reserve would focus more on protecting the economy than they would about kind of getting inflation down to that 2%, that last mile, which is always going to be really hard, right? And so if you don't think they're going to be so focused on inflation, that means that kind of right now, that means over the medium term, you're probably going to get slightly higher interest rates, which is kind of why we saw them kind of ticking up and long-dated stuff in the background as well.
Yeah.
I've explained it very well, actually.
No. That does make sense. And I guess when going back to what we were talking about with China, they were starting to see significant deflation, which was opening up the opportunity for more intervention. And I guess that's what we have to remember, is that quite often the extra money creation, the credit creation that can be turned on by the powers that be, they're allowed to kind of do that because there is natural deflation that occurs within most economies. And maybe that's what's starting to inform some of the judgment with these Federal Reserve governors is maybe they're thinking, Know that long term, we're going to be dealing with deflation as a natural symptom of technology or whatever over time. Therefore, we can probably afford to be a little bit more lax inflation. And therefore, it's really, like you say, it's about preserving the stability and the integrity of the system now, more so than making sure that prices are quote unquote stable. Be accurate as well?
Exactly. That's 100% it, right? But actually, it's fascinating, right? I'm having a quick look at China, kind of the interest rate curve of China when we're talking, right?
Yeah.
It's really interesting where yield at the moment is pretty low, so kind of short-dated stuff in that 1.5%, all the way up to kind of a 30-year Chinese bond. I'm not sure how liquid this is, so I'm not sure how accurate the data is, but it's still only at 2.2%, right?
What's that?
So what that's implying, it's still only at 2.2%.
Okay.
With a 10-year kind of only slightly lower. So actually what this is implying is that China's stuck with very low interest rates for a very long time. I think that the interest rate market is almost saying, hold on a sec, we kind of declining population, spend on property, overspend on infrastructure. This feels like Japan from 30 years ago.
Okay. So there are cyclical trends, there's secular trends. Here in New Zealand, one of the big, massive other trends, demographics. And this isn't unusual to New Zealand, of course. I was actually talking to someone at the New Zealand Super Fund a few weeks back around this very issue. And it's come up, it's definitely on the radar at the moment in terms of rising healthcare costs and the rising share of expenses that New Zealand Super will actually take going forward because of the demographic shift. Sorry. We are probably both things. We are getting older as a country. In the 70s, there was 15 workers to every one person that was retired receiving government super. Today, there's 4. Tomorrow, in the future, in 50 years' time or so, there'll be 2 workers for every one. It's totally unsustainable. And NZ Super Fund is charged with trying to invest a bunch of money so that they can help fund that government's obligation. But it's going to get harder and harder as time goes on. And we need markets to kind of grow exponentially. Where are we at with this? Are we we're not sleepwalking into a crisis here because we're talking about it right now. But it seems to be a little bit unfair that those who are going to get the short end of the stick, the ones who have no say in the matter, like younger than us, will be screwed. But they've got no say in it. It doesn't seem right, does it?
If they mobilised and voted, they would. The problem is that the voting population, we've talked about this quite a bit before, right? On average, it's the older people that vote versus the younger people. And so if they really wanted to, they could figure it out and get together and actually create action. The problem is that the political parties that we currently have are busy protecting the status quo versus kind of trying to kind of protect the next generation, right? It's a really interesting kind of stat, right? So you talked about the kind of 15 people supporting every single person over 65. Now there's 4, that's 2. The other stat that I found fascinating when I was looking at this, our healthcare budget. 42% of our healthcare budget goes to supporting people over 65, despite the fact that they only make up 16% of our population. So and this is all about to get a whole lot worse, right? So kind of some of the key stats the Treasury have been talking about. Things like NZ Super as a cost is going to grow from 5.5% of GDP up to 7.5% of GDP. Said a different way, currently 17.5% of our tax take is used to fund NZ Super. 15 to 20 years' time, that number is going to be 21%. So that's an extra 3 to 4% of GDP that we need to find just to fund NZ Super. Healthcare is the same, right? Going from 7% of GDP currently up to 9% of GDP because of these aging populations. So there's some pretty scary numbers that we need to kind of figure out, but we're unwilling to actually kind of think about it. Talked about 3 or 4 weeks ago, we talked about universal basic income and UBI. And we talked about one of the big risks is that someone actually provides it and does it, right? Because I think in New Zealand, what we've seen is that once a benefit is provided or once a service is provided, and sorry, this isn't just New Zealand, this is all over the world, but once a benefit or a service is provided to anyone, it just stays and it's impossible to take away. We've seen that with the pension scheme, which only came in the 1970s. We saw it with Working for Families in the early 2000s, which I think is a great program, by the way, so I'm not having a go at it. We've seen it with free universities. We've seen it with healthcare. All of these things, the state will always get bigger because no one's ever going to vote for a party that says, hold on a sec, we're going to take a whole lot of stuff away.
Yeah.
And that is our problem, right? And then we're also lax. So you kind of go, cool, so we've got a political problem. We've got a problem of kind of a whole lot of benefits that we can't really afford. And the tax system is also highly structured to basically tax those under 65 versus those over 65. And by that, what I mean is, if a lot of people over the age of 65 still actually earn really good income because they've got investments, whether that be a rental property, whether that be a KiwiSaver account, whether that be kind of shares or their retirement savings, a lot of them still earn really good income on all of this, but they earn it through capital. And so actually, not only do we have a benefit scheme which is skewed to the over 65, we've actually also got a tax system which is skewed to make it so that the under 65 have a hell of a lot more, because when you're over 65, more of your income comes from capital versus actually PAYE and working. So yeah, there's a whole lot that's going wrong, but we're nowhere near brave enough to fix it.
Okay, well, let's dip into those waters then. The contentious capital gains tax waters. New Zealand has a very, very complex, convoluted tax system with each government from both sides introducing exceptions for their favorite team and all the rest of it. And it's kind of been reignited recently. So the CEO of ANZ, Antonia Watson, she's advocating for the introduction of CGT. I always wonder if this is like a bit of a game that politicians play with the business community where they firmly oppose it. But really, it's actually a great way to bring that conversation to the fore and actually go, well, could capital gains tax actually solve the problem that we were alluding to before, which you were going into there, Rupert, where all this wealth sitting in people's properties past the age of 65, when they've stopped earning income, effectively they pay no tax at all, but their wealth continues to grow, and then they eventually pass it on to their kids, tax-free as well, and there's a concentration of wealth in fewer and fewer hands. So the first question I have a lot of questions on CGT, but the first question I'll ask you is, what problem does a capital gains tax solve?
So I'm going to answer a slightly different question, right? What problem does capital gains not solve? Personally, I do not think it's a solution for our housing crisis and our house prices. I'm just going to put that out right there.
Yeah.
I don't think it's a solution to raise a whole lot more revenue because I think it needs to be offset by tax cuts somewhere else. The problem that I think capital gains helps us solve is the problem that I'm not wealthy enough to do this, unfortunately. I wish I was. But a lot of people choose how they make their money. Some people make their money through investing. So if I had a whole lot of money and I decided to go and invest that money and I'd been successful in investing that money, I can live off those investments and I can continually trade those investments. And you know what? I'm going to earn really good income on that. And I can structure that in a way that I can pay zero tax. Alternatively, I've got to work pretty hard and the investor often, they work extremely hard as well. So that's kind of hard work on both sides. But alternatively, if I don't have any capital and I decide that, you know what, I'm not a very good investor, I just want to go off be a lawyer or an accountant or a builder, the issue is I can earn great money doing those things, as much money as the investor. But because I'm doing it with my time and with my PA and getting paid through PAYE, I have to pay tax on that. And to me, that's the bit that I think this is kind of looking to cover. You should be taxed irrespective of how you earn your income. Income is income, right? There shouldn't be a difference of I earn my income because I do a whole lot of work and pay my time versus I earn my income because I'm a really good investor. That's the problem that I think this solves. And then I kind of go one step further forward and I look at us as an aging population where we're going to have less people working. A lot of these people have got huge savings accounts and huge retirement accounts that have been built up. And I go, we've talked about all of these problems on less workers supporting more people in retirement. That problem is actually exacerbating and going to get a whole lot worse if we continue to only tax PAYE and consumption, by the way, with GST. Then what we have is we're going to have a bigger and bigger problem those who pay tax because they're working will end up having to pay more and more tax to support the benefits of the over 65s who aren't paying tax because a lot of their income is coming through capital gain.
Yeah, I can see some logic there. I guess I'm truly suspicious of more government rather than less government. Just assume that if they introduce a new tax, they're probably not going to reduce taxes by the same amount elsewhere for the younger people.
What I would love to see from either party in Parliament is I would love for them to say, you know what, I think based on everything that we see, on kind of our current tax take, based on where our competitor countries sit, based on kind of the services that we want to deliver as a country, I want to be kind of taxing New Zealand at 30% of GDP. Currently, we're about 33, or maybe it becomes 33. But kind of, I think if you came out with a very clear statement of where I see the fair tax take sits, we're going to introduce capital gains. But the moment that we see capital gains start to actually increase the tax take in this country, then we've kind of got a firm commitment to bringing down other forms of tax, because our North Star is at 32, 33%. And that's the number. And I think that's the part of the conversation that we can't have right now, because we can't have a conversation which is, this is the fair amount of tax that we think we should be paying as a country. What we're doing is we're saying, here's the tax that's going to mean we pay more tax. Whereas actually, I think we need to separate the two conversations and go, what's the fair amount of tax we want to pay as a country for the services that we want to receive? And what's the most efficient and fairest way for us to raise that tax? Those are two entirely separate conversations. But the problem is we're mixing them up.
Yeah. No, I guess you're right. And the question I have in the back of my head as well. Sorry, what's that?
I just never thought I'd hear you say that there's that we were right, and maybe a capital gains tax might not be so bad.
Did I say that? Oh my goodness. Then no, I think there's like a bit of interference on the internet that you didn't hear that. So the problem I have is, why on earth is the CEO of ANZ bringing this up?
A company, a very wealthy company, and focuses on a 10-year plan, not on a 3-year plan. And they are focused on the much longer term than our current politicians, because our current politicians are only focused on the next electoral cycle. And so you kind of fast forward, if you're ANZ, largest bank in the country, most profitable company in the country, at the end of the day, who's going to pay the price for a lot of the issues when these things all arise? They will, because if you're the company, if you're the government, you're going to have either, as a country, we're going to see much more immigration, so a lot more people leaving the country, because we've got a tax burden which is kind of set on a much smaller number of people. You're going to need potentially higher corporate tax rates. There's a whole lot, and you also potentially end up in a world of social unrest, right? So if you are a good corporate citizen that's looking out for kind of, you know what, I still want to be the most profitable bank in the world and earning extortionate kind of over-market rents in 15, 20 years' time, I need a stable society and I need a stable tax system. And I think what she's pointing out today is she doesn't have that.
Okay. Yeah, no, a fair comment. And I guess it makes sense as well, because what we're looking at in the future certainly points to rising asset prices. And there's really no end to that. And so as it relates to property, that might sound like, hey, that's great. The bank's position is going to get stronger and stronger over time if the security that underpins all of their new currency creation is growing in value, then their overall risk is shrinking. But the faster we go, the bigger the mess. I guess if there is a pullback in the future because GT is introduced in the future, it may have an immediate sharp, might eventually go away, but there could be an immediate sharp correction, right? It's better to be pulling off that Band-Aid now rather than later. Do you think there's a bit of that going on too?
I think it's just to happen, right? And I would also argue the other reason why I think she's probably trying to push for this is that and look, might be reading what I want to read here, but it feels as though the population is now starting to push for this, right? You're getting a lot of kind of business people. I think if you did a nationwide poll, most people would kind of say some form of capital gains tax is coming in and needs to come. And I guess she's also kind of, the other way she's looking out for herself is saying, hey, I'd much rather National do it, because National are more likely to do it in a sensible way than labour with the potential for a wealth tax or much higher tax rates or other things as well. So there's a whole, I think, I'm not sure whether it makes a big difference whether you do it today or do it in the future, but I do think it makes a big difference as to who does it.
Yeah. Yeah. And just to clarify, just because I can't live with the idea of me going to sleep tonight thinking that I might have been pro capital gains tax, just to be really clear. I don't want any tax. I don't think any tax should exist because we have a central bank who can tax through the financial system. One of my things that I can see happening maybe in the next 5 years, maybe a bit longer, will be central bank issued digital currencies. I'm having a conversation with somebody really smart about this shortly. And to prepare for that, I've just kind of really gone into the weeds a little bit about how this could work. And we kind of traditionally have looked at the fiscal side and then the monetary side as two distinct entities. And things get blurry at times in terms of political interference and all the rest of it. But we have a programmable form of money that knows where it came from, i.e. a large family home was sold and then the money was given to the kids. And as soon as that money is there, it can actually split off some money basically to the government or the central bank. And so I wonder if what we're grappling with right now are the symptoms in an analog world, which we really struggle to solve because it requires democracy to solve it. And not that I want this either, but I think in the new world with digital currency, we won't have a democracy problem. We'll have the ability to take what is required, or the government or central bank will have the ability to take what is required. So I think that the new solutions for the new world will actually be quite simple and, dare I say, even elegant, not just a tad dystopian, but I think we'll get there.
I mean, look at what the IRD is currently doing on Bitcoin, right? And I find that a really interesting example of one where they're going, cool, they're kind of serving notices to all of the crypto exchanges around the world and going, cool, let us know whenever you've got a New Zealand citizen that's using your exchange. And what digital currency has allowed them to do in a very quick, simple, efficient manner is just trace all of the transactions back, right? So they're almost telling people what their capital gains and losses were because they can see the transaction.
Yeah. Yeah, that's what happens with open blockchains. Yeah.
I do. I mean, it's a little bit like what we talked about last week with the BlackRock stuff, right? I find it, you do slightly humorous that a financial system that was meant to be kind of born outside of the traditional financial system actually is making governments' lives easier by giving them more access to more information.
Yeah, for now. It could be a Trojan horse, remember, right? So for now, it might not be contained for long. Who knows? It can destroy. It can destroy like it can create as well. So I think like where we're at in terms of our age range, right? Like hopefully we're in the peak income producing years of our lives. We have another 15, 20, 25 years to go before we reach retirement. I think what we're going to see before we reach retirement will be solutions. We'll probably see solutions to the equity consideration in terms of some people over here, hey, they're building wealth using assets and they're dodging the tax bullet. That's not fair because they're receiving all the public benefits at the expense of the working class who are giving away like almost 40% of their income. So I can see solutions to that coming. I just think that it might not be through the traditional avenues of introducing new taxes. I can kind of see that there'll be a lot more innovation when CBDCs do come in. Fascinating. And full loop back up to China, right? Like China is already there. They'll evolve and they'll innovate, right? But I think, again, it'll be interesting to see what it looks like when you and I are retired and well, you'll be there a little bit longer than I will. It'll be different than it is today.
I think we're going to have to work so hard to pay off these awful mortgages. We'll never be able to retire.
Right, cool. Well, thank you for that conversation. We covered a lot of ground today. So next week, no doubt, Chinese markets will be down by 20% next week. Who knows? We'll see. But we'll catch up next week.
I hope so. For the sake of my emerging markets fund, which has had its best run out of all time over the last week, I really hope that...
I'm into that. Cool. All right, Rupert. We'll catch you next week.
Cheers. Thank you. We'll speak soon. Bye.